Yesterday's CPI data was released showing inflation down 0.1% from the previous month. What this meant on a trailing 12-month basis, it is sitting around 3%, the lowest level over the last 3 years. And in fact, what this has meant more importantly for the market, a lot of sector rotation, a lot of red for those companies that have been performing very well, the likes of Nvidia, Microsoft, moving into those undervalued sectors with very high yields, as the market does now believe that we are going to see an interest rate coming very soon, therefore making it incredibly attractive to hold on to high yielding companies. Today's focus, 7 of the safest companies paying very nice yields. As we go along in today's episodes, the yields will get higher. Now, the first one we're looking at is Agree Realty Corporation. It is essentially in the REIT industry. And one thing we will touch upon is that historically, when the Fed has finished increasing those rates, REITs will outperform. So a very good time to consider. Now, when we take a look, one thing to note, they do pay monthly, so a very nice bonus. And the forward yield sits at 4.71%. We get a triple buy rating across all analysts and a P to FFO that sits around 15.6. Now, over the last 12 months, no surprises, down around 3%. Given the macroeconomic conditions when interest rates were hiked, it is very typical for companies like this to essentially be hit hard. Over the last 10 years, however, we do note it is up around 107% and currently sits in the mid to upper end of the 52-week range. Now, as we said, we are looking at those that only have safe dividend scores, and as we can see, a 70 safe score, very nice to note. We will point out, though, their latest increase was a little bit mediocre at 1.2. Ideally, we do want to see around 4% just to keep up in line with inflation on a year-by-year basis. Now, jumping into the valuation model, our intrinsic value at $69. The way we get to this, as always, if you do watch our deep dives, we run through every single one of these models. Today's episode, we're jumping straight into that calculation of $69. We have the current price of $64. What we always like to do is start off with a margin of safety. Now, bear in mind, some of these high yielders may not have a massive amount of upside. What you are getting, though, in return is very high yields, which will hopefully outperform when interest rates do come down and people do start looking to find ways to put their money in very nice yields. So a 10% margin of safety for this company would be around $62. Now, it isn't too far currently, but right now you are getting at least a minimum of 5 to 10%. As always with Wall Street, do take their estimates with a pinch of salt. If the share price rises, they will revise this upwards, and the same if it goes downwards. Currently, though, they do see around 5% upside over the next 12 months. When interest rates do inevitably come down, we will expect a lot of these companies to take off given their yield. We then move on to Philip Morris in the tobacco industry with a double buy and a hold from Quant. It is trading right there at the 52-week highs. A very nice forward yield. Remember, as we go along, the yields will get higher at 4.95%. Forward P sitting just below 17. For those that want to know, S&P right now around 23. And over the last 12 months, it is up around 6.5%. Over the last 10 years, it is up around 19.46. We can see, in fact, all-time highs around $122. We're talking about 7 years ago. When we talk about the dividend safety, well, again, safe score of 64. They did increase their dividend at 2.4% in September, so we are expecting another increase over the next few months from Philip Morris. When we look at the intrinsic value of $105, for us personally, we see it trading at a fair value. With Wall Street, however, they do see some upside of 6%. Over the next 12 months, their price target of $111. And for those who do want to capture this company at a 10% margin of safety, you would have to be waiting around $94, $95 as the price target. As always, as we go through along these companies, do let us know your thoughts in the comments below. We then move into the telecom industry, Verizon Communications with a double buy rating and a hold from Quant. We have this at the upper end of the 52-week range, a yield of 6.44% and a forward P just above 9. Over the last 12 months, well, nice performance, up 18%. Over the last 10 years, however, it is downward trending, negative 19%, but again, does come down to the type of investor you are, and we can see that nice safety score of 70. Similar to the previous company, though, a mediocre increase at 1.9%. This September, hopefully we can see at a bare minimum that inflationary increase. When we talk about this company's value, well, $45 is what we arrive at, and with a margin of safety at 10%, you would have to wait around $1 shy, so you could justify around a 10% MOS based on our estimates and judgments. With Wall Street, they do see this going marginally higher than our calculated intrinsic value. They see 11% upside for this company that does now yield over 6%. We then move on to Dominion Energy. Now, we do get a triple hold from this company. It is trading at the upper end of the 52-week range with a yield of over 5%, forward P of 18.5, and pretty much flat over the last 12 months. If you've been a shareholder over the last 10 years, well, you would be down around 26.4%. In terms of the safety score, well, it does sit at that 70 safe, and we haven't seen an increase yet for that dividend over the last few years. Now, when we take a look at this company's value, we're pretty much seeing it not too far off its intrinsic value at 52.59. In terms of margin of safety, then again, if you are waiting for 10%, you would need to see it around $47. In terms of upside right now, Wall Street themselves also see 3%, hence why we did get that triple hold rating. We then move on to another monthly dividend payer. It is Realty Income with a strong buy from Quant and a double buy from the other two analysts. Trading now in the midpoint of the 52-week range, forward yield of 5.74% and a P to FFO of 13, just below that P to FFO for real estate. Over the last 10 years, again, similar to ADC, the industry has been hit by the macroeconomic conditions, negative 9%. Over the last 10 years, though, up around 19%, hasn't yet fully recovered from the highs that we saw just previous to the pandemic at $80. In terms of dividend safety, well, a score of 80, it does look to be safe, and a 3% increase over the last full year. Bear in mind, they do increase this a few times over the year. In terms of the valuation, well, this is one that we have reviewed in detail on this channel. Our intrinsic value at just under $65 does give a nice MOS level. 10% a buy at $58, 15% a buy at $55. So pretty much right now in today's climate, we do see a 15% margin of safety. Wall Street themselves, as we saw, a buy signal upside of 11%. Bear in mind, with this company, you are getting a nice forward yield. It does also pay every single month. Before we move on, just to let you know, we have released our latest free weekly article. Now, this also comes with a free spreadsheet running through all the dividend kings, which ones we see as undervalued, which ones we see having a ton of upside. Access to this and any other articles, all completely free by clicking on the pinned comment below. We then move on to Pfizer, the next safe dividend company with a double buy rating, the hold from Quant. It is trading right there towards its 52-week lows. In terms of forward yield, well, just below 6%. Forward P around 12. And when we take a look over the last year, it has been hammered down 20%. Again, if you want to see why, do check out our individual deep dives. Over the last 10 years, again, negative 3%, as we can see, downward trending since its highs of 2021 in December, around $60. Having said that, the dividend safety does look to be safe at 75. We're also seeing it offer one of the highest yields over the last 5 years. And again, not the greatest increase in December at 2.4%. We are always aiming for that minimum 4%. Bear in mind, though, the majority of these do pay very high yields in comparison to others in the industry. Intrinsic value then, $32. Bear in mind, you can grab a copy of this valuation model by clicking on the pinned comment below, putting in your own numbers for your own companies as well. Margin of safety then, at that 10% level, it is a buy at around $29. Not yet at the 15%, you would have to wait for around $27.47, so sitting somewhere between the 10 to 15% mark. With Wall Street, very bullish. They do see upside of 17%. Their price target of $34 would indicate it would be a great time to consider for the portfolio. High yield and some nice upside and a decent amount of margin of safety if you believe in this company over the longer term. We then move on to the highest yield that we have today, and interestingly, it has a strong buy rating from Quant, a double buy from the other two analysts. It is trading right there in the mid to upper end of the 52-week range, 7.19% yield, and in terms of the forward P, well, 10.65. On top of that, nice performance over the last 12 months at around 10.3, considering the high yield. Over the last 10 years, however, it is down around 25%. Main thing we want to see with these companies, their dividends are safe. We get that with a score of 65. And nice to note as well, not only a very high yield above 7%, but they've increased it by 5% over the last full year, indicating it is increasing above inflation. In terms of the valuation, well, our price of around $33, as we can see, the current price of $29.19, again, indicates some nice margin of safety. You are getting at least a 10%. Now, for those looking at 15%, you would have to wait for just under $28. On top of that, Wall Street also indicate this as a buy, upside 14%, which is always great to see for those that do have those nice high yields. Now, for those that prefer ETFs as an alternative for the security, there is also the ProShares S&P 500 Dividend Aristocrats ETF. We see it trading at the mid to upper end of the 52-week range. Now, its yield on a trailing 12-month basis is lower than the ones we've been through today at 2.17%. The expense ratio, not too bad either at 0.35%. Over the last 12 months, it is up around 3%. Over the last 10 years, up around 111. When we take a look at the ETF's top 10 holdings, we have a lot of very well-known names. All of these as well have increased those dividends at a minimum of 25 years consecutively. In terms of comparing their performance against other ETFs, well, as you can see here, the ones that we are comparing it against, it does have one of the lowest expense ratios, 0.35. The one coming closest, QDIV, at 0.2%. In terms of how they've performed, now this includes reinvesting those dividends. Over the last year, it isn't too dissimilar from the others. As we can see, HIBS, the one that has performed the worst, in fact negative. Over the last 5 years, we do see it pretty much consistently at the upper end. Over the last 10 years, though, again, we do see it not just at the upper end, but actually the best performing, and it does look very attractive considering it had the second lowest expense ratio. As always, let us know your thoughts about today's episode, whether you're adding any of these to your own portfolio, whether you're considering the ETF, and if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.